myself, Dr. Harpreet Kaur, Associate Professor in Commerce. Dear students, I welcome you all in the Department of Distance Education, Punjabi University, Patiala, on joining Master of Commerce MCom course. The present video is for first semester students and I will share with you the details about the fifth paper, that is Financial Management, and also the Personal Contact program which is going to start in the next week. Students, before coming to the department for attending classes, you should go through the syllabus and study material which is already available on the department's website. You should read all these chapters in detail and come with the list of questions. During the PCP classes, you can consult your subject teachers and clarify your doubts. This personal contact program will be of 5 days duration and the timings will be 10 a.m. to 4 p.m. It will be really beneficial to you if you attend all the classes. Now, I will give you a brief overview about the course content of the fifth paper, that is Financial Management. Financial Management is concerned with the management of financial affairs of the business. We all know that finance is very important for any organization. It is said to be the lifeblood of any enterprise. Now we come to the syllabus of this paper. The syllabus comprises of 2 units. Unit 1 starts with the meaning, objectives and scope of financial management. Financial management refers to that part of management activity which is concerned with the management of financial resources of any enterprise. It is the duty of financial manager to arrange funds from suitable sources and at minimum cost. Most appropriate use or proper investment of funds also forms important part of financial management. There are 2 main objectives of financial management. First is profit maximization, which is an owner-oriented concept and it ignores the time value of money and quality of benefits attached with an investment. Second objective is wealth maximization, which is universally accepted objective. It focuses on the interest of stakeholders as well as shareholders and tries to maximize the net present worth of the firm. Next are the 4 major decisions to be taken by a financial manager. First is the financing decision of a firm. It relates to the choice of the proportion of debt and equity sources of finance. It includes when, from where, and how to arrange the funds to meet the firm's requirements. Second is dividend decision, which means that what proportion of profits should be distributed among the shareholders in the form of dividend. Next is the third decision. It is investment decision. It is related with the selection of long-term and short-term assets of the firm to maximize the returns. Fourth decision is liquidity decision. It focuses on the level of current assets and working capital management of the firm. Next topic in Unit 1 is capital budgeting. Capital budgeting is the process of making investment decisions in capital expenditures. Capital expenditure is an expenditure incurred for acquiring and improving the fixed assets, the benefits of which are expected to be received over a number of years in future. capital budgeting decisions are very important decisions for any firm as they involve large investment of funds for a long period of time and also impacts the profitability of a firm. Then there are various methods for the evaluation of capital investment proposals. These methods are traditional methods and modern methods. When we talk of traditional methods, there are two methods which are considered to be traditional methods. First method is payback period method. In this method, we select the proposals having lowest payback period. Next method is rate of return method. In this method, we select the proposals having highest rate of return. Coming to the modern methods, we have three methods in modern methods. First is net present value method, second is internal rate of return method, and the third one is profitability index method. In modern methods, we evaluate the proposals on the basis of present value of cash flows. In net present value method, we take the present value of cash inflows and compare it with present value of the outflows. And if we have the positive net present value, then we select the proposal. Then we come to internal rate of return method. This is a hit and trial method. Internal rate of return is that discount factor at which the present values of inflows is equal to present value of outflows. Third method is profitability index method. In profitability index method, we calculate the ratio of present value of inflows with the present value of outflows, and if the ratio is greater than 1, then we accept the proposal. We also teach you various techniques used for handling risk and uncertainty in capital budgeting. Our next topic is cost of capital. Cost of capital is the minimum rate of return expected by the investors. It is the overall cost of various sources of capital used by the firm. Cost of capital is very important for any firm as it acts as a determinant of capital mix and is also considered as a basis for evaluation of the financial investments. Then comes the computation of cost of capital. It has two parts. First is the computation of specific sources of finance, that is cost of debt, preference capital, equity capital, and retained earnings separately. Second is the computation of overall or composite cost of capital on the basis of weighted average. And last topic of Unit 1 is leverage. Leverage is the employment of an asset or source of funds for which the firm has to pay a fixed cost or fixed return. Due to this, the earnings available to the shareholders and also risk is affected. There are two types of leverage: operating leverage and financial leverage. Operating leverage is the firm's ability to use fixed operating costs to magnify the effect of changes in the sales on its operating profits. Whereas financial leverage is the ability of the firm to use fixed financial charges to magnify the effects of the changes in operating profits on the earnings of the shareholders. The product of operating leverage and financial leverage is combined leverage, which is also a measure of the total risk of the firm. Coming to the second unit of our syllabus, First topic is capital structure. Capital structure means composition of capital of a firm, which includes long-term capital resources made up of debt and equity securities, for example, debentures, equity capital, preference capital, and shareholders' funds. Every firm should aim at achieving the optimal capital structure, which means that proportion of debt and equity where the cost of capital is minimum and the value of firm is maximum. There are 4 theories of capital structure which forms very important part of this chapter. These theories are net income approach, net operating income approach, traditional approach, and approach. Various factors determining the capital structure of a firm are also studied in this chapter. Some important factors can be cost of capital, size of business, and financial leverage. Our next topic is dividend policy. This chapter focuses on the decision of the dividend declaration by the firm. In this chapter, we have 2 approaches with regard to dividend decision of the firm. First approach is irrelevance approach, which means that dividend decision has no effect on the valuation of the firm, as decision to pay dividend is a residual decision. If the funds are not required in business, they are distributed among the shareholders, and the value of firm is determined by the earning capacity of the firm. Second approach is relevance approach. Relevance approach suggests that the declaration of dividend will increase the value of the firm. Our last chapter is working capital management, which focuses on the level and composition of current assets and current liabilities, and also tries to have balance between profitability, risk, and liquidity. Working capital is a short-term capital required by the business to meet its day-to-day activities, like purchasing of raw material, payment of wages, salaries, bills, etc. We also teach you various factors which determine the working capital requirements of the business, like credit policy, production cycle, inflationary trends, availability of loans, etc. And the last thing which we study in working capital management is the financing of working capital. Here we will cover various long-term and short-term sources for financing the working capital needs of the business. Normally, the long-term sources are used to finance the permanent working capital, and the short-term sources are used for financing the temporary requirements of the working capital. Now we come to the evaluation part of this paper. This paper is for 100 marks, and these 100 marks are divided into 2 components. One is the internal assessment, it will carry 30 marks, and the external paper will be of 70 marks. So for the purpose of internal assessment, we will give you assignments, and we will send your internal assessment on the basis of your assignments. Thank you.